Good day, fellow investors. Interactive Brokers is a good stock to buy now and perhaps an even better broker to check out. If we look at the stock price, the P ratio is 16, but they are growing their numbers between 10 and 20%, and they will likely continue to do so. So it is a good relative buy at the moment from that perspective. And this is a covered stock on my research platform. And if you want to read it, you can read it here, but just to note here that I am updating all the covered stocks with the full new investment thesis, because as the yearly earnings get in, so you can read, this one is for free preview. As an example, you can also read how I put together these theses on these companies. There are still good buys. So now, if you want to learn the businesses, it's a great time to join my research platform. And I want to really discuss here Interactive Brokers, the summary, and there are 4 key factors that I want to discuss. They are a good relative buy. The relative part is to discuss. They are not doing buybacks. They have large employee compensation, but they are still growing. And there is a very interesting interest rate comment by the CEO. Let's start immediately with the company overview. As I already said, they are growing 20%. This is the basis when you add customers. And they have a lot of client equity, and they have their own equity with no debt. The potential for this business is very high, as they have 2 million customers, but the population is closely getting to 8 billion. There are a lot of financial assets, and people are turning more and more to global online brokerages that can offer them lower costs because of the scale, and you have very low margin loan rates there. You have good money on the excess cash that you have on there, and therefore client accounts have boomed lately, and also consequently client equity. This is also connected to what I do, because one of their growth strategies is to work with influencers. And if you look at any of my videos, if you go into the description, you see what I do here on the platform, but also Interactive Brokers link. And if you click on that link, I get a small fee for just you clicking. So please do that and check out the broker to see how it fits you. And it really supports the channel. Thank you. And if they continue supporting smart influencers and keep their quality, look at the awards: Best Online Broker, Best Broker for International Trading. Now that international stocks are cheap, it might be something to consider. So again, check the link in the description below. If we go to how good this business is, the profit margins was 70% this year, which is insane. When you have such high profit margins, it means you are a quality business, and whatever happens, you will keep making money. However, one reason why they make so much money now, the earnings are close to $6 per share, are higher interest rates. If interest rates go lower, then they don't make that spread, so they will have lower earnings per share, but still good earnings per share. Therefore, if all else remains equal, this is a great buy now, growing at 20%, P ratio 15. But if things change, it's not really an absolute buy there, because of the huge increase in net interest income that went up to 2.7 billion compared to 1.6 billion in 2022. If interest rates go down, valuations will expand, of course, and things will return to normality. So that is the risk and reward. If you think interest rates will go higher and inflation will stay here, then this is a company that gains on that, and vice versa if interest rates go lower. So an interesting potential hedge to a portfolio. How much do they lose if interest rates go lower? I calculated a little bit. If we have interest rates going from 5.5 to 1.55, they would lose 1.2 billion in profits, from 2.8 billion to 1.6 billion. Still profitable, but not the same valuation there. Now, a very interesting take by the CEO on interest rates. He thinks that because of increased shipping and transport costs, geopolitical issues, bad demographics leading to increased cost of skilled labor in developed countries, and deficits, where large deficits leads to spending and higher interest rates lead to even larger deficits, the high cost of environmental spending, he sees the potential for rates to go as high as 7%, which is something very possible and a different opinion than what the market has. Time will tell, but it is a very, very interesting situation. Now, they just keep making their money. This is divided by 4 because they have an interesting ownership structure where the management owns 74%, publicly held, the float is 25%. So they decide to divide the profits only to the public float, and then you see 600 million on 9.3 billion, and that is the PE ratio. Now, another very interesting take by the CEO, not doing buybacks because that would push the stock higher, and there is no sense in doing that. They own the business, and let's say they spend 5 billion to do buybacks. Those that sell the shares get the shares. And now let's just explain this. He says that if he would spend the 5 billion that he has on buybacks, the float is just 9 billion. So the 5 billion entering, I think the float would explode to 40 billion because the stock price would quadruple. But, okay, what would he achieve with that? Nothing if he's not selling the stock. And he owns the stock because it's a great business. He wants to do an acquisition to grow the business. And maybe someday down the road, he will sell the whole business. But if he buys back half of the stock, the eventual selling price might even be lower because of the 5 billion he spent. So this is, again, a counter Wall Street idea. You can read more in detail in my report, but it's very interesting to see how this CEO thinks. There is a lot of employee compensation, 7% dilution in a year. It is there. You would not like it as an investor, but what can you do? They are growing fast, making a lot of money, and they compensate their employees. So, very interesting situation here. As I said, it's a relative buy. To be an absolute value investing buy, I would say I would need those interest income to go down to just have the underlying commission businesses, and then the stock also to go down, and then when interest rates go up again, because those will, then it might be a very, very interesting buy if the underlying business is still strong and growing. So relative buy, absolutely. Absolute, not yet.